Markets around the world are on edge as the Israel-Iran conflict escalates, but some investors are already positioning for both risk and opportunity. The Tel Aviv Stock Exchange's TA35 index rebounded after an initial drop, closing higher even as violence and uncertainty gripped the region. Israeli stocks like Checkpoint Software and Teva Pharmaceutical showed resilience, and the iShares MSCI Israel ETF recovered losses, demonstrating that local investors may be looking past immediate headlines and betting on the long-term strength of Israel's financial system. The Israeli shekel weakened, but the Bank of Israel kept financial systems running smoothly, signaling confidence in the country's liquidity and preparedness. Oil is the global wildcard. Brent crude and WTI surged over 7% in a matter of days, and the mere threat of Iran blocking the Strait of Hormuz has traders whispering about $200 or even $300 oil. This isn't just a headline risk. 20% of the world's oil moves through that narrow strait. Any disruption could send shockwaves through energy markets, spiking gasoline prices, squeezing corporate margins, and triggering a new wave of inflation. Energy stocks and ETFs like XLE, IXC, XOP, and PSCE have all seen renewed momentum. Exxon and Chevron are climbing, and the midstream giants, enterprise products partners in energy transfer, are suddenly the darlings of defensive investors. EPD, with its 26-year record of growing distributions and fortress balance sheet, is favored for its conservative growth and resilience, while ET offers higher yield for those willing to take on more risk. Options traders are targeting out-of-the-money calls on these names as volatility spikes. Defense stocks are another clear winner. Lockheed Martin, Northrop Grumman, General Dynamics, and Raytheon all rallied as investors anticipate increased military spending and new contracts. ETFs like ITA and PPA, loaded with these names, have outperformed the broader market since the first missile struck. Palantir is a special case. Its AI-driven defense and logistics software is in high demand, and the NATO Maven deal plus potential Golden Dome contracts have fueled a 45% surge this year. But as analysts warn, Palantir's valuation is now stretched, and the stock is trading on momentum and narrative as much as on fundamentals. For new investors, it may be better to wait for a pullback or use options to hedge risk. Gold has hit all-time highs, surging past $3,400 an ounce as investors seek safe havens. Gold ETFs like GLD and GDX are attracting inflows, and even silver and copper are catching a bid as hard assets come back into favor. Utilities and consumer staples, think Procter & Gamble, Duke Energy, and Imperial brands, are also seeing renewed interest as investors rotate out of high-flying tech and into defensive sectors that can weather stagflation and economic shocks. Stagflation is the word on everyone's lips. Rising oil prices, sticky inflation, tariffs, and a cooling labor market are creating the exact conditions that punished investors in the 1970s. The risk is that economic growth stalls while prices keep climbing, a toxic mix for most stocks. In this environment, growth stocks and long-term bonds tend to underperform, while oil, gold, hard assets, utilities, and value stocks historically outperform. Short-term bonds and cash can provide a safe harbor, but investors are also looking at floating-rate loans and companies with strong pricing power and low debt. For those seeking international diversification, Israeli equities have shown surprising resilience. The iShares MSCI Israel ETF, after an initial drop, rebounded as local investors shrugged off the worst-case scenarios. Saudi Arabia, through the KSA ETF, offers exposure to Aramco and a market trading at a significant discount to the S&P 500. European defense contractors like BAE Systems and tech leaders like ASML are also in focus, as NATO spending rises and the continent rethinks its security priorities. Emerging markets are a mixed bag. India's Reliance Industries is seen as a relative winner, able to diversify oil sourcing and benefit from global supply chain shifts. Turkish and Egyptian stocks, by contrast, are seen as too exposed to regional instability and are being avoided by cautious investors. Options and tactical trades are everywhere, Some are buying leap calls on energy and defense stocks. Others are hedging with puts on the S&P 500 or going short overvalued tech names that could be hit hardest if stagflation takes hold. Inverse ETFs and volatility products like UVXY are back in play for those betting on more turbulence. The barbell strategy is gaining traction, pairing high-quality, defensive, dividend-paying stocks and hard assets on one end, with select growth or tactical trades on the other. Investors are holding more cash, ready to buy dips, but also rotating into sectors and geographies that can benefit from crisis-driven spending and supply shocks. What about shorting? Some investors are targeting overvalued tech stocks and consumer discretionary names that are vulnerable to higher rates and energy costs. Others are looking at long-dated puts on market indexes or leveraged inverse ETFs as insurance against a deeper correction. For long-term investors, the message is clear. Don't panic, but don't ignore the risks. Diversification across sectors, geographies, and asset classes is more important than ever. Focus on companies with strong balance sheets, pricing power, and exposure to secular trends like AI, defense, and energy infrastructure. Keep an eye on valuations. Momentum can reverse quickly in times like these. If the conflict escalates and oil supply is disrupted, energy and defense stocks could continue to outperform, while the broader market faces headwinds. If tensions ease, expect a relief rally, especially in beaten-down sectors and international markets. Either way, staying nimble, hedging risk, and having a plan for both upside and downside scenarios will be key. In the end, geopolitical crises are nothing new for markets. They create volatility, but also opportunity for those who can keep their heads and stick to a disciplined strategy. Whether you're looking to protect your wealth, generate income, or capitalize on tactical trades, now is the time to review your allocations, rebalance, and make sure your portfolio is built to withstand whatever comes next. Stay informed, stay diversified, and remember, sometimes the best defense is a good defense.